Hello everyone, welcome to the 152nd episode of me learning how to trade in Forex. So in the last episode, we went through what is the stock market. Basically, as the name implies, the stock market is a marketplace where shares in public companies are bought and sold. Its role is to give private investors a way to become partial owners of a business to benefit from the profits it generates over time. This also helps listed companies raise capital through investors that they can use to grow their business. So the shares are listed on a particular market in a specific country, such as the London Stock Exchange in the UK. And then when a company wants to sell the shares through an exchange, it has to apply to become listed. And then once it's been approved, it has to follow the rules set out by the local financial services regulatory institution. So when the exchange is open, stock prices will fluctuate constantly as shareholders buy and sell the shares based on the sentiment about the company's prospects and how investors react to economic and political events. So shares in a company may go up or down at any given time, but they usually respond directly to news about the business or the sector it's in. So for example, if the company reports increased profits, or if it promises a dividend increasing faster than inflation, then the share price is likely to rise. So that's where we stopped off in the last episode, and in this episode we're going to carry on from where we left off at. And yeah, so let's get started then. So how can you invest in the stock market? As well as the prospect of your investments growing in value, you can also look to buy shares to benefit from dividends. These are the portion of a company's profits that are usually distributed among shareholders as a one-off or regular cash payment. So, dividends. Portions of a company's profits that are usually distributed among shareholders as a one-off or regular cash payment, but can also be paid in property or further shares of the stock. In property, okay, but can also be paid in property or further shares of stock. The 100 biggest companies listed on the LSE or the London Stock Exchange form the FTSE 100 index, which aggregates the share price movements of all its constituent companies. Did you know a stock exchange is a group of shares that are used to give an indication of a sector, exchange, or economy's performance? So, a stock index is a group of shares that are used to give an indication of a sector, exchange, or economy's performance. It's made up of a set number of the top performing shares called constituents from a given exchange. It's made up of a set number of the top performing shares, so constituents from a given exchange. For example, the FTSE 100 is an important indicator of the UK stock market and economic health. You may have also heard of the DAX, which tracks the top 40 stocks on the Frankfurt Stock Exchange, and the Dow Jones Industrial Average, which tracks the top 30 companies on the New York Stock Exchange, and the National Association of Security Dealers Automated Quotations, or NASDAQ. Over the course of 2021, the FTSE 100 rose by 14.3%, its best year since 2016, and generated a further 3.37% in cumulative dividends. That's an annual total return of more than 18%. That's massive. While this gives a good indication of the returns the stock market can produce, remember that past performance is not a guarantee of future results. remember that stocks' past performance is not a guarantee of future results. If you're investing in the stock market, you could do this by buying a stock index like the FTSE 100. But since an index isn't a listed entity, this would involve purchasing shares in each of its 100 constituent companies, a complex and costly process. You could alternatively pool your money with other investors in a fund that offers exposure to the same companies. The cheapest way to buy an index is with an exchange-traded fund or ETF. More on this shortly. You'll learn more about the different types of the assets available to investors later in this course. So what is an ETF? An exchange-traded fund is a type of investment fund that's bought and sold on stock exchanges. Exchange-traded fund. So a type of investment that's bought and sold on stock exchanges. ETFs are designed to track performance of a group of companies that form an index, like the FTSE 100, or sectors such as energy, agriculture, and healthcare. So, ETFs are designed to track the performance of a group of companies that form an index, or sectors such as energy, agriculture, and healthcare. They can also track individual markets like gold, oil, or the USD. They can also track individual markets like gold, oil, or the USD. Types of ETFs: stock index ETFs, sector and industry ETFs, geographic ETFs, leveraged ETFs, inverse/short ETFs, commodities ETFs, currency ETFs. So lots of ETFs available. The price of an ETF reflects the collective value of the assets it tracks. So the price of ETFs reflects the collective value of the asset it tracks. For example, a FTSE tracking ETF might hold shares in all of the FTSE 100's constituent companies. Its value will be based on the share price of each company, so if one rises in value, the price of the ETF will also rise. Like stocks, the ETFs are shares that you can buy or sell on an exchange. This means you can gain exposure to the performance of an entire index or sector with just a single investment. So ETFs are shares you can buy or sell on an exchange. For instance, instead of buying shares in many individual energy companies, you could buy shares in one ETF that tracks the energy sector. From one transaction, you'd gain broad exposure to the industry's combined performance, and subsequently have only one investment to monitor and manage. ETFs offer a low-cost way to invest in a wide range of equities, bonds, properties, commodities, and other assets. They're also free from stamp duty in the UK. ETFs are free from stamp duty. However, it's important to read an ETF's prospectus or key investor information document before invest. It's important to read an ETF's prospectus or key investor information document before invest. Tax laws are subject to change and depend on individual circumstances. Tax laws may differ in a jurisdiction other than the UK. Okay, so let's just summary. The stock market is a series of exchanges where shares are issued, bought and sold. When a company becomes listed on a stock exchange, private investors can buy shares to own a stake in that company. A country's stock market is regulated by governing bodies such as the FCA in the UK and the SEC in the US. You can invest in a wide range of sectors such as agricultural and energy using ETFs, as well as asset classes like gold and bonds. Cool. Discover the investment landscape. So discover the investment landscape. Date is the 31st. There are many ways you can invest in the stock market. It's important that you have an overview of the different types of investments vehicles available for your portfolio. In this section, we'll help you understand how some of them work along their benefits and drawbacks. Example, say you invested £10,000 into a 10-year government bond with a 5% annual coupon. I'm guessing that 5% annual coupon means a 5% annual return. Each year the government will pay you 5% of your £10,000 as an interest, and at the maturity date they will give you back your original £10,000. Okay, wait, let me just read that again. Say you invested £10,000 into a 10-year government bond with a 5% annual coupon. Each year the government will pay you 5% of your £10,000 as interest, and at maturity date they will give you back your original £10,000. Wait, so 5% of 10,000, that's... I should know this straight off. Why is that so hard? 5%, is it 500? Wait, 10,000, 0.05? Yeah, it's 500, okay, 500. So, you get £500 each year. And at maturity date, they give you back your original 10,000. So overall, you end up with 500 times by 10, that's 5,000. You would end up with £15,000 back. If you invested the same amount in company shares, there's no guarantee that you'll receive a dividend, even if the company performs well. This is because some companies will instead reinvest profits into growing the business. Additionally, when you sell your shares, the amount you get may be higher or lower than your initial investment, depending on how the company's worth has changed over time. So basically, in the government's case, that's a guaranteed return. I guess you get £5,000 back. So you get 50% of your investment back in over 10 years time. I don't know if that's loads or not, but yeah. I'm assuming not because it's only 5%, isn't it? So yeah. So this is like a small but guaranteed return, whereas this, you might get higher, but it's not guaranteed. Or you could even get less. So yeah. Bonds. Bonds behave more like savings accounts than traditional investments. Bonds behave more like savings accounts than traditional investments. The difference is that you take on a bit more risk when you lend money to a company or government. The difference is that you take on a bit more risk when you lend money to a company or government. The difference is that you take on a bit more risk when you lend money to a company or government. That's because if the borrower can't pay you back, you could only get back a percentage of the money you lent them. That's because if the borrower can't pay you back, you would only get back a percentage of the money you lent them. But the reward for taking this risk is earning a higher interest rate than you would at a bank. Plus, you can choose bonds whose returns are linked to inflation to ensure your returns are always above it. Bonds also have a maturity date, and your return is guaranteed if you hold them until that point. However, they can still be bought and sold along the way. Bonds also have a maturity date. Your return is guaranteed if you hold them until that point. But then they say if the borrower can't pay you back, you only get percentages of the money you lent them. Is that before the maturity date then? That's because if the borrower can't pay you back, you can only get back a percentage of the money you lent them. You can only get back a percentage of the money you lent them. You can choose bonds whose returns are linked to inflation to ensure your returns are always above it. Bonds also have a maturity date, and your return is guaranteed if you hold them until that point. Bonds also have a maturity date, and your return is guaranteed if you hold them until that point. However, they can still be bought and sold along the way. However, they can still be bought and sold along the way. Equities. Equities are riskier than bonds, but both can have their place in an investment strategy depending on your goals and attitude to risk. The higher the proportion of equities in your portfolio, the higher up the risk ladder you're going. So the higher the proportion of equities in your portfolio, the higher up the risk ladder you're going. But the potential for generating better returns should also theoretically increase. However, you also stand a greater chance of losing money on your investment. If you primarily invest in bonds, it's a lower risk strategy, but also one that's likely to produce lower returns. Equities are shares. Property. Property is an asset class just like equities and bonds, but it's a different kind of investment. It's used to diversify holdings within a portfolio. With property, you're investing in physical buildings such as office blocks, shopping malls, and business parks. They produce a return from their rental income and may also grow in capital value. Properties produce a return from their rental income and may also grow in capital value. Property is similar to equities in that it has potential for growth, and like bonds, it promises a reliable income stream. But property can also be volatile depending on the state of the property market and the economic cycle. So, properties can be volatile depending on the state of the property markets and the economic cycle. Other asset classes. Other popular asset classes include infrastructure, where you invest in the debt used to build schools, hospitals, and other public or private investments. You can also invest directly or indirectly into physical commodities like oil and gold. Infrastructure, oil and gold, etc. Tax wrappers. Stocks and shares individual savings accounts, ISAs. Chinese government bonds, gold, inflation-linked bonds, emerging market stocks, emerging market bonds, UK stocks, European stocks, UK government bonds, investment grade bonds, US government stocks, US stocks. An ISA is an account that receives generous tax breaks from the government to encourage you to invest or save. So, individual savings account. An account that receives tax breaks from the government to encourage you to invest or save. It enables you to protect your savings and investments from tax on capital gains, dividends, and interests. It protects your savings from and investments from tax on capital gains, dividends, and interests. A stock and shares ISA therefore acts as a tax wrapper for your investments. As the name suggests, you can hold stocks and shares and some other assets within the ISA wrapper without having to pay any tax on capital gains or dividends. There is a set ISA allowance for each tax year. There is a set ISA allowance for each tax year, which represents the maximum you're able to invest in your ISA. Which represents the maximum you're able to invest into your ISA. Self-invested personal pension, SIP. Self-invested personal pension. A SIP is a type of pension available to UK residents that grants you greater freedom when investing for your retirement. While other types of employee or personal pension only allow you to select between a set number of funds, a SIP enables you to choose exactly what you want to trade from a wide range of investments. This is usually include, but isn't limited to, ETFs, commercial property, fixed income products, commodities such as gold, stock listed on a recognized exchange. A type of pension which grants you greater freedom when investing for your retirement. A SIP while other type of employee or personal pension only allow you to select between a set number of funds, SIP enables you to choose exactly what you want to trade from a wide range of investments. These usually include, but isn't limited to, ETFs, commercial property, fixed income products, commodities such as gold, stock listed on a recognized exchange. SIPs are subject to the same tax benefits as other types of pension, so you receive relief relative to your current income tax rate. SIPs are subject to the same tax benefits as other pension, so you receive relief relative to your current income tax rate. SIPs are subject to the same tax benefits as other types of pension. So your receive relief relative to your current income tax rate. Just remember that tax laws can change and will depend on your individual circumstances, and that tax law may differ in a jurisdiction other than the UK. So you receive relief relative to your current income tax rate. Receive relief relative. So does that mean you won't get to pay tax you won't have to pay tax depending on your current income? Maybe. Okay, lesson summary. You can invest in a range of assets like equities, bonds, properties, commodities, ISAs and SIPs. Equities enable you to invest in a company's performance, while bonds are a fixed debt-based investment and enables you to invest in a company's performance, while bonds are fixed debt-based investment. Fixed debt-based investment. Investing in property lets you profit from a rise in capital value as well as rental payments, but the risk is in the potential downturn of property values. You can invest in commodities like oil and gold whether or not you choose to own the physical assets. ISAs and SIPs are tax wrappers where you can make tax-free investments with a limited annual allowance. So it's tax-free, SIPs are. Okay. Investments with a limited annual allowance. What are the risks involved with investing? What are the risks involved with investing? Investing is not a one-way ticket to the riches. Assets prices can fall as well as rise, and there are no guarantees that you will make money on your investments. That's why saving cash is considered a safe option. You earn interest with your bank or building society, your saving pots grow slowly, and there's very little risk of you actually losing any money. However, with low risk generally comes low returns, and if the interest you're earning is below the prevailing rate of inflation, then the real value of your cash savings is actually diminishing. For example, say you deposit £1,000 in a savings account that grows by 1% annually. In 1 year you'd have £1,010, but if inflation grows by 2%, you would need £1,020 to have the same buying power you started with. Right, okay. So, asset prices can fall and rise. There's no guarantees that you'll make money on your investment. That's why saving cash is considered a safe option. You can earn interest with your bank or building society, your savings pot grows slowly, and there's very little risk of you actually losing any money. However, with lower risk generally comes lower returns. So safe option is a savings account. However, if the interest you're earning is below the prevailing rate of inflation, then the real value of your cash savings is actually diminishing. Then the real value of your cash savings is actually diminishing. For example, say you deposit £1,000 in a savings account that grows by 1% annually. In 1 year, you would have £10,010, but if inflation grows by 2%, you need £1,020 to have the same buying power you started with. Below the prevailing, so your interest rate for the savings account must be higher than the inflation rate for you to have for your cash savings real value to be not diminishing. Equities have historically delivered higher returns than cash over the long term, but share prices regularly fall as well as rise, and some companies fall completely or fail completely. While you invest with expectations of generating positive returns, you must also accept that you could end up with less money than originally put in. Equities have historically delivered higher returns than cash over the long term. However, share prices fall and rise. Therefore, you must be able to accept that you could end up with less money than you originally put in. Did you know, while it's common for people to invest in individual companies, a balanced investment portfolio includes multiple other assets. As you've come to learn, you can also capitalize on potential growths of ETFs, investment trusts, mutual funds, and many other assets. You can build your own portfolio or employ a specialist individual or company to do this on your behalf. Understanding your own appetite and tolerance for this risk is a key part of investing. Ask yourself how much you're willing to commit into the markets, but also how much you can afford to lose if they happen to move against you. You must understand your own appetite and tolerance to risk when investing. Diversification. One of the most effective ways of managing risk is by diversifying your portfolio. Diversify your portfolio to manage your risk. This involves distributing your funds across multiple asset classes such as shares, bonds, gold, or property. So, diversifying involves distributing your funds across different asset classes. For instance, government bonds are a much lower risk investment than shares and should produce fairly consistent returns. This will help to reduce the negative impact on your portfolio if the stock you hold fall in value. Below is an example of a balanced investment portfolio that includes various assets spread across many regions. So we got different locations, Chinese, UK, US, and then we got different asset classes. So we've got commodities, bonds, shares. Yeah, so good. Very good. Building a diverse portfolio of assets can help you manage your exposure to market fluctuations. So building a diverse portfolio of assets can help you manage your exposure to market fluctuations. If you invest in the stock market, for example, you may consider holding shares in different companies from various economic sectors in order to diversify your investments. This will help to spread the risk within your portfolio, making it less reliant on the performance of one company or a sector. So even within the same, asset classes, there's still methods to diversify your investments. You can also diversify your investment within the same asset class, i.e. in the stock market, buying shares in different companies from various economic sectors. In order to diversify your investments, this will help to spread the risk within your portfolio, making it less reliant on the performance of one company or a sector. So I guess the important thing about diversifying is you don't want to be reliant on one asset or one thing. You want to be like everyone balances each other out, I guess. So if one makes a loss, then hopefully you can have another one which makes a profit, and then that cancels each other out. This will spread the risk by making it less reliant on the performance of one company or sector. Spread the risk within your portfolio. For example, when there's an economic downturn, consumer-facing companies like retailers may see their shares fall in value as customers tighten their belts and revenues and profits fall as a result. However, pharmaceutical and utility companies should fare much better during periods like this because the products they sell are considered essentials and aren't as prone to economic fluctuations. Buying individual shares is therefore a high risk strategy, and one that can leave you overly exposed should they underperform. Assembling a decent sized, well diversified portfolio is generally a much safer bet. Lesser summary: the value of shares can fall as well as rise, so there's risk you may sell them for less than when you paid. One way to mitigate this risk is to build a diverse investment portfolio that includes a broad range of sectors and assets. When you build your portfolio, consider how much risk you're willing to take on, including how much your investment you're prepared to lose if the market turns against you. How much of investment you're prepared to lose if the market turns against you? I guess you got to be prepared to lose everything, don't you? If the market turns against you. So invest an amount you're comfortable with losing. 100% would be the way to go, right? Because there is a possibility that you're going to lose all of your investments. So you need to be comfortable with that. When building your portfolio, consider how much risk you're willing to take on and how much of your investment you're prepared to lose if the market turns against you. Cool. I am going to leave this episode here. So in the next video, we're going to carry on with Am I Ready to Start Investing? So thank you all for watching, and I will see you guys in the next video. See ya.